Blizzard, winter, or ice age. That's what I'm calling this presentation. I'll explain why in just a minute, but I just want to let you know I'm going to try to do at least a weekly video for all the clients. The main reason I'm doing it is just because I'm getting quite a few of the same questions from folks. I'm not trying to defer anybody from contacting me individually. I just want to make sure that everybody's getting good information. And I'm assuming that when certain clients contact me with questions, that probably everybody has the same questions. So, hopefully there'll be a lot. But again, if you do have any kind of individual questions or you find I'm not covering something you want, please reach out to me. I'm more than happy to help, especially during these times. I might also try to do maybe a Saturday, sort of a coffee with Kurt kind of thing. And then you could chime in, listen to some of the questions that other clients have. You could throw some questions at me. Obviously, that would be something you wouldn't want personal information divulged, but it could just be a way to get a, kind of a Q&A going. So I'm going to try to get a lot of information out there. It's not because, I'm panicking. I'm just trying to make sure that you feel comfortable with everything that's going on in this crazy, crazy world. So again, blizzard, winter, or ice age. Why am I going to talk about that? What's the importance with it? First, just hit the quick agenda. So I'm going to try to talk to you a little bit about bear market behaviors, just to give you an idea of what we might be in store for. I'll then jump to what am I looking to do now? That's try to get that information to you quickly. So if you don't want to listen to all of this webinar, you don't have to. And then I'll finish up with kind of some more meat and potato stuff, looking at some longer term issues such as stock valuations, debt to GDP, maybe trying to make some conclusions on really what we're looking at here overall. But if you just kind of want to get in and out, I'll try to get to all that information right away so you can just listen, figure out what I'm going to do, get on with your life. But if you're kind of a money nerd or a numbers nerd like me, you can get a little bit more information here. So, when I talk about blizzards, winter, or ice age, what I'm talking about is, what is this? What is all of this? Is this coronavirus going to be just an economic blizzard? And what I mean by that is, are we just going to have a ton of snow here, and then a week or so later, we won't even know it hit? I always use the Colorado example. It could be the middle of April and they could get 10, 12 inches. And by 2 days later, it's 60 degrees and you don't even notice that there was ever any snow to begin with. So is this an event where we have a short-term impact, but then it's going to climb from here? I don't know. Not sure, but it is a possibility. What this chart you're looking at shows is the volatility index, also called the VIX. So as you look historically going back into the early 90s, we kind of have a tight range there, but there's two outlier points to the upside, one in 2008 and then one today. So, if you were looking at this and it was snow, it was like annual snowfall, you'd say that we had really two bad storms. So is this just going to be kind of a storm that we get through? We shovel it out, it melts a few weeks later and on we go? Or are we looking at something a little bit deeper? Now, a typical bear market, and that's what I would define as a winter. And the reason I call it a winter is it may be a little bit longer than what a big snowfall would be or a blizzard, but you tend to get through it. That spring and summer are on its way. So a typical bear market, the typical winter bear market, you see a sharp drop, just like we've had now, followed by a very sharp retracement up. And then you get kind of a slower, steady decline as the process bottoms out. What I always like to say is a bear market likes to inflict as much pain on people as possible and on the maximum number of people. So what happens is, with the sharp drop, the way the bear gets you is people sell stocks. They get out, they sell. And then you get a retracement. And then people go, oh, okay, looks like it's over. Let's jump back in. So they sold as it was dropping, usually near the end of the drop. They jump back in when you get the retracement. And then it's just kind of a slower decline that sort of kind of eases people into a bigger loss. That's what we had in 08. 08 in September, October, we saw the market drop about 40%. And then we actually saw the market come back up. So from the end of October of 08 until January of 09, you saw about a 25% retracement. And then the market for the next 3 months just faded down and basically hit the market bottom for a total of 52% top to bottom. That's a typical one. But another thing you have to remember, if this is a winter, if this is kind of a normal bear market, you can ride this thing out. Most bear markets, you're talking, they're anywhere from 6 months to about 18 months. Okay, that's what you're looking at for most bear markets. This chart does a great job of showing you most of the bear markets. Yeah, there's a lot of red periods there, but if you look at the corresponding blue, the up periods, they're much greater. Okay, so if you put it in perspective a little bit, yeah, okay, we're going to have a winter, but there's definitely the spring and summer coming. Now, the only one on here that's really kind of alarming is the one to the far left, which was the Great Depression. That clearly was a doozy. And that's what I would categorize as an ice age. That was something that clearly went on for much longer than a typical bear market and was much deeper than any kind of bear market. And we'll talk a little bit more about that in a bit. I wanted to kind of just show you some of the previous bear market recoveries going all the way back to November of 1916. So you can kind of get an idea. Most of these are what I would call the typical winters. You do have the September 1929 to November 1954 period. That's the Great Depression. So it literally took all that time to kind of get back to break even when you factor in an inflation adjusted basis. That's pretty painful. You're looking at darn near 30 years, 25-year period where it really took a long time. So that was definitely an ice age period. Then you look at the period right below that, August 1987. So many of you probably remember the crash in October of 1987. What you had was from August 87, it started to fade a little bit. And then in October, it accelerated, losing about 25% just in that month alone. But once that happened, the market kind of lifted up. This is definitely the snowstorm scenario. It just kind of continued upward from there, didn't really have a retracement followed by another downturn. It just headed straight back up. So if we're facing a situation where we get through the coronavirus here, at least getting, past the bell curve, we could see this. If we have pent up demand and the economy gets rolling, we could have that happen. But if you look at the other periods, you're going to see mostly a typical bear market or a winter market. You've got kind of a initial downturn, you get some rallies, but then you get another fade down south until it bottoms out. So, I don't know what's going to happen. I can't tell you, but, the big thing is to think about what can we do? Just to kind of put things in perspective a little bit so far, this is looking at the S&P 500 fund, SPY. From the peak where it was at 340 a share, if you get down to the 32.8% decline, that would take us to the bottom of the 2018 bottom. So December of 2018, a 32% from the peak would get us to that point. Now we've already gone through that point. This chart was a couple weeks old when I pulled it off the internet. So we've already eclipsed that. And to continue to put this in perspective, we could see a 50% retracement or downside, and that would take us back to the essentially 2016 lows that we had way back. Really kind of more the 2015, but at the bottom of the beginning of 2016. So don't be surprised if we pull all the way back. Even if we do, though, remember, that's only taken us back 4 years as far as the growth. It's not taking us any further than that. And that's a 50% decline, which is pretty steep. So what am I doing? Well, the big thing, as you can tell, I'm not sure if this is just a huge blizzard, if it's a winter, or if we're looking at an ice age here. I think the key thing is all three of them, you could make the case for any of the three. So I'm going to be extremely, extremely flexible. Now, as most of you know, I use the 200-day moving average to kind of guide me as to when to sell equity positions and go to cash or bonds. And I did that for most of our equity holdings, not all of them. I kind of left individual stock positions, but I sold most of the bigger ETFs and the bigger index-based investments. But the thing is, we had a market that was 3 standard deviations above the 200-day moving average. So the market had to drop darn near 15% before I even made any moves at all. So usually I use that 200-day moving average. Now, at this chart, when you're looking at it, the blue line is the current price of the Vanguard Total Stock Market Index, VTI. The red line is the 20-day moving average. So that's the closing price over the past 20 days of VTI. And you can see that while it's certainly not as volatile as the blue line, it definitely moves a little bit quicker than the purple line. The purple line is the 200-day moving average for VTI. So you can see I usually use the 200-day moving average because it's a longer-term trend. It's less noise, so you don't have as much movement. You don't have as many sales, buying and selling. I try to be, as much as possible, a buy and hold investor. We don't want to make a lot of changes. Only do it when we're breaking a long-term trend. But because I think we're going to see a lot of volatility, and even in a normal bear market, we see this big drop, and we could see a big move up, followed by another drop. I think the 200 days is just not going to be very effective here. So I'm going to be looking at the 20-day moving average. Now, when you look at this 20-day moving average, this is a couple days old. It was 139 per share for VTI. And when I did this slide, VTI was trading at 111. So you can say, well, that's a big difference. We got to wait for it to come up $28. Well, remember, a 20-day moving average is every day 1/20th of it is moving out and another one is coming in. So we're getting to the point now where all of the 20 days in the average are going to be from the move down. That's kind of where we're at. So you're going to see that 20-day moving average go from 139 and quickly come down to the 120 level or so, just because of the points that we're going to be using here to make up the 20 days. So I don't want to, like, today was a big day in the market. It was up 10%, but it's still below the 20-day. I don't want to be in and out, because at that point you're really guessing if you're not using any kind of metric to guide you. Now, the 20-day is going to be pretty responsive. So if it blasts above the 20-day, we're going to get back into equities, and then we'll just continue to ride that thing up until, or if it breaks back below the 20-day, and we'll get back out. So what you're going to see from me is a lot more buying and selling than usual. I try to be a buy and hold as much as I can. I think that too much action is actually a bad thing. Again, that's why I use the 200-day moving average. It's a much slower moving technical indicator. But I think right now we're in a period where we need to be a little bit more flexible, a little bit more adept. Another thing I'm going to do, I'm definitely going to be using some of the broad-based, index-based ETFs, but I'm also going to add more individual stocks than I've done in the past. I do think this is a good opportunity to get into some individual stocks that have been beaten down or that offer compelling valuations, much more than the market overall. I'm going to be leaning heavily on my information from the Motley Fool, all their stock picking prowess. But I think there are some good values out there, and hopefully we can do that with some individual positions. Still going to have an extremely broadly diversified portfolio, but we'll have a little bit more in individual stocks. And the beautiful thing is, now that the brokerages are going to zero commissions, we won't have any commission costs for adding a few extra positions to your portfolio. One last thing I do want to point out about this chart. The thing is, we've had a lot of volatility both up and down the past 2.5 weeks. But when you look at the blue line, what you notice is that the big moves up are not reaching the previous highs. So we're getting lower highs, but the drops are creating lower lows. That's not a good sign. Okay, that's a sign of a bear market. A lot of volatility coming up. So even the move today of a 10%, if we retrace and give most of that back again, that kind of tells me we're still going to be heading south. We'll see. Nobody can predict the future. Typically, big moves like that are still an indicator of a bear market. So if we were facing a ice age, and this is a chart of the market for 1929 to 32, overlapped by what's gone on so far. Okay, it looks pretty scary. It's overlapped, almost a perfect correlation there. But what you notice that even if we have a serious drawdown that takes 2 or 3 years to get through, there are a lot of periods within that move where we have anywhere from a 15 to a 30% increase in the market. This is, again, the reason why I'm looking to use the 20-day moving average. There's a good chance what you can do is capture a good portion of the upside and still protect yourself on the downside. What I'd be trying to do here is to try to capture at least 85% of the up while only getting 15% of the down. No guarantees that could happen, but you could see from this chart here that even during the Great Depression, the overall trend was horrible, dropping down over 70%. But there were pockets where, if you were flexible and moved quickly, you could get some good upside. So again, talking about the whole snowstorm, winter, or ice age, you've really got to look at the depth of the recessions. This chart gives you an idea of the recessions dating back to the 1980 recession. If you look at the 1980 and 82 and the 08 recession, really the gross domestic product, or the size of the economy, only shrunk anywhere from 5 to about 7.5%. They weren't extremely deep, whereas the Great Depression, which would be an ice age, went down over 20%. So the 80, 81, 82, and then 08 were more of the typical winters. We saw unemployment bust up to about 10%, and we saw a 5 to 8% drawdown in GDP. So think about that. As bad as 08 felt, the market dropping 53%, home prices getting pummeled. As bad as that was, we only saw a 7% decline in GDP. So you can imagine if we went to a 20% decline, what this is going to do. Now, if you look on here and you see the 1987 to 89, you'll notice there was no recession. Again, this is the kind of the snowstorm effect. So 87 had some imbalances that caused the market to pull back, but it didn't cause a recession. The economy continued to grow. So, we could have that. I think a recession is already baked in the cake for this. The fact that we're going to see at least a 20% decline in March and April for companies is going to be a recession when you look at the full year 2020. I mean, if this quarter is down 20%, you're at best you're looking at about a 7 or 8% decline in the GDP for the year. So you're looking at a winter. I do think that the snowstorm scenario is probably overly optimistic, although you can't be ruled out. I think at best we're looking at a winter kind of situation where we might be fighting through this thing for a year, and we'll see at least 7, 8%. We're going to see unemployment bust up to 10 from its low of 3. That's kind of the best case. If we have the Great Depression kind of scenario, well, again, we're looking at 20% decline there and maybe even 20, 25% unemployment. And before you think that might not be possible to experience something like that again, I want you to understand that there are so many businesses right now, small businesses, that have little to no income coming in. I was just reading a report that said that of the small businesses out there, They figure based on average bank balances and cash flows, most small businesses can keep their full staff on for about a month before they'd have to start laying people off. And if they laid off 10% of their workforce, that would get them to the beginning of May. And then they'd have to still continue some deeper cuts. If they laid off 50% of the workforce, they could get to June. That's assuming like revenues stay really low. So if this pandemic causes us to be pseudo quarantined until June, you're looking at 50% of employees who work for small business owners, and that's 79 million people being unemployed. So that's 38 million people going onto the unemployment rolls. And that's just from small business. You throw in some big businesses, and you even just throw in the small businesses that are going to go under. Most small businesses just can't go months without any kind of revenue. It just can't be sustained. So, I think we have to expect that the ice age is on the table. Hopefully it isn't, but if it all depends. And even if we were to come out of this thing pretty soon and started to get back to some sort of pseudo normalcy, where maybe we're just having the older folks shelter and then younger folks are doing their herd immunity, even in that situation, have people change their behaviors? If we go back to work, are we going to go back to spending like we were before? Or are people going to be a little bit more cautious, which is going to slow any kind of economic rebound? So it's hard to tell. Now, the thing that scares me about all of this, and which I think could lend to the ice age possibly, is we were starting from an awfully high valuation in the stock market to begin with. If you watch my previous video, when I explained about getting out the 200-day moving average, I talked about how we were at a all-time high as far as stock market valuations. But if you use several different metrics, a few metrics still had the year 2000 peak being the highest, but there were some that had our current peak as being the most richly valued stock market valuation ever. Things like price to sales, enterprise value to earnings before interest, taxes, and depreciation and amortization. This is another chart. I'm not going to spend too much time on it, but you could pause this video to look at it. But here's a few others, most of them having us at least in the 94th percentile for valuations. So we had a market that was already priced to perfection. And then we have a situation where we're taking a massive economic hit, especially condensed economic hit. What valuations, they don't tell you anything about the short term. They don't tell you anything about market movements. But what they do a great job of telling you is about future returns. They give you a good idea of what you can expect over the next decade. So this was a chart before the market tanked. And looking at four of the metrics that I use a lot, the Case-Shiller CAPE index, cyclically adjusted price to earnings, Tobin's Q ratio. Warren Buffett uses the market cap of the stock market divided by the GDP, and Paul Tudor Jones has a valuation as well. Even before the crash, we were looking at potential 10-year returns of anywhere from 2.6% in the S&P 500 to annually down 4.1%. So the market was extremely richly valued. And even with the markets pulling back like they have, what we're seeing is we're only back to the peak of the housing bubble right now. And remember how the housing bubble, that bursting took the market down 53%. So that's where we're at as far as valuations right now. This is based on the total market cap to GDP, which is Buffett's favorite metric. Again, I'm not trying to scare you. I'm just trying to put some perspective that we're still pretty richly valued, even at these levels. And we have no idea what earnings are going to do. Now, the good news with it is the fact that the market has pulled back this far. It does project that we'll have better 10-year returns going forward. So valuations obviously have gotten better because the market has dropped over 30%. So you can see here, based on the four ratios I like, the CAPE, the Q ratio, Buffett indicator, and price to book, we're now looking at least at having 2.5%, 3% to maybe minus 1 or 2% over the ensuing 10 years. So it does look better at this point. So I think that's a good thing that we're looking. going forward. Now, the thing is, I always tell people that valuations don't tell you the short-term movements, but they tell you long-term returns. But there's never been a time with an extreme overvaluation hasn't been corrected by a downturn. So maybe getting this flushed out of the system, we can enjoy some good returns going forward. Now, the one thing that the stock market has had going forward all along has been the central banks just pumping liquidity into the markets. This is a chart showing you the S&P 500 compared to central banks pumping the liquidity. You can see there's almost a perfect correlation as the central banks pumped liquidity into the markets. As they were accommodative to the markets appreciated it and went up. This is a chart showing you dating back from the 08 debacle through 2013. And you can see every time the Fed did any kind of quantitative easing, the market jumped. So QE1, which started in December of 08, cost a 42% market rise. When that QE stopped, the market dropped 11%. And then the Fed stepped in with another QE. We saw another 24% rise. And then that ended, market pulled back 14%. They did another QE, up another 20, and repeat, rinse, repeat. And this happened also in 2018. They were raising rates and selling assets off their balance sheet in 2018. And we saw from October to December, the market pulled back 18%. Fed panicked. They started pumping money in. And then we had 2019 and saw a 30% increase in the market. Well, what is scary about this is the Fed has now thrown a bazooka load of ammunition at the market. This was a chart just from a week ago, comparing the $307 billion that the Fed had purchased, increased their balance sheet, compared to what they did in March 09 at the bottom of that bear market. So they've already doubled that almost. And subsequent to this chart being done, they've now done another $1.5 trillion. They've even expanded to the point where they're going to accept not just treasuries, but municipal bonds. They're going to accept mortgage-backed bonds and even corporate bonds. So the Fed has absolutely unleashed the liquidity beast. Now, the bad thing is, despite them coming in with the biggest liquidity that they've ever done, the market has been tanking still. Every time the Fed has lowered rates or come in with QE, the result has been a downward market. That isn't good. That kind of tells me that the fear of the unknown here is even greater than the absolutely unprecedented massive stimulus that they've kicked in. And I'm not a fan of these, the stimulus for short term, but the problem is they never take it away. I mean, you can make a really good argument that in 08, they pumped in so much stimulus and they continue to do that. They kept continuing to push debt that we never really fixed the problem from 08. It just got bigger. And if you've been a client of mine for any sort of time, you've seen this chart. This is a total U.S. debt compared to the size of our economy, the GDP. And you can see there's two massive jumps here. One of them is the peak in 1930, the Great Depression, and then the peak of 2008. So at the peak of the Great Depression, we were looking at about 200% debt to GDP. So $2 of debt for every dollar of economic activity. And this debt is government debt, corporate debt, individual debt. In 2008, that ratio hit 360%. So $3.60 of every dollar of economic growth. That's just unheard of. It pulled back a little bit after the 08 crisis, but it hasn't come down that much since then. So we have not only a market that was priced to perfection, but we really have an over-indebted economy. This is a slide showing you the debt ratio for just U.S. government debt to GDP. So we're well over 100% debt to GDP now. You can see even at the peak of World War II is only 118%. Now with the potential of another $2 trillion fiscal stimulus coming, we are definitely going to be looking at a $3 trillion deficit just this year alone. So, I mean, that means we're probably going to be at 115, 120% debt to GDP for government debt. And this is domestic corporate debt. So corporations have been taking on massive amounts of debt, and we're up to 74% corporate debt to GDP. So we have a massive amount of debt that is really going to be a stranglehold on the economy. Because if you think about it, debt can be a tailwind to you as an individual. if you're spending more than you make and you're using credit cards, you can do that for a very long time and live above your means, because the minimum credit card payment is about 2% of the balance. So you can do that for a long time, and you're producing more economic activity because you're spending more. But eventually that catches up to you, and that 2% becomes too big of a number for you to make the payments. At that point, we have no good choices. It means you either cut back your spending, which then hurts the economy. It means that you default on the debt. So what that means, obviously that's horrible, because now we have deflation, the debt's being eradicated. Or what you have is a situation where you have to start selling your assets to cover your expenditures. In this case, it would be like if you're in a position where you have to sell stocks or bonds in order to cover liquidity calls or something along those lines. That too creates downward pressure. So we have a kind of a headwind with debt. So again, I'm not trying to bum you out, but you need to understand kind of the ramifications we're looking at. If this turns into more than just a short-term economic blip and turns into a situation where we have a balance sheet issue, where we're talking about solvency of small businesses, of individuals, and even large companies, if this debt is eradicated or defaulted on, it's going to be highly deflationary, which is not good for stocks or the market. So that's kind of what we're looking at. Again, the big takeaway for me is I'm going to be probably in and out more than you've ever seen before. I'm going to try to be extremely flexible, making lots of moves, looking at that 20-day moving average. We're going to tighten things up quite a bit, just to make sure that we do catch some of the upside, but also to protect us if the market tends to back down and head south. I am approaching this as if we're entering an ice age, so something even worse than a normal winter bear market. As I've mentioned before, I think the snowstorm or blizzard is probably too optimistic. I'd love for that to be the case. We kind of hit that exponential downside for the diseases. We know that the healthcare workers are going to be not overwhelmed, and then the market just picks back up from where it goes. That'd be awesome. Not sure that's going to happen, but this is kind of giving you an idea of what I'm thinking. Again, I'm going to try to get these out every week to you. I'm also going to, like I said, probably try to do something for a Saturday, just a little Q&A where you can log in and we can just sit and chat a little bit. But if you have any questions in the meantime, please do not hesitate to ask me.